Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Nokia stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Nokia is a telecommunications, IT, and consumer electronics company. The company is headquartered in Finland and was founded over 150 years ago. It is the pride of Finland and the largest company in that country. It went public in '92 and trades on a lot of stock exchanges. The New York Stock Exchange, London Stock Exchange, the Nasdaq Stockholm, Nasdaq Helsinki, and a bunch more. It employs people in over 100 countries, pretty much all around the world, as you can see from this chart. It was once the largest provider of mobile phones in the world, but sold that business to Microsoft in 2014. After the sale, it began to focus more on its telecommunications infrastructure business and on Internet of Things technologies. Nokia did return to the mobile and smartphone market in 2016 through a licensing arrangement with HMD Global. It also generates a lot of money by licensing patents to other large mobile phone providers. Let's get started with the model. This is a large cap company. 31 billion market cap. They're trading at $5.48 a share and they have 5.6 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had negative free cash flow in 2018 and 19, but positive in 2020 and the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative in most years, a small positive in 2019. Revenue is a sales for the company, and that's pretty consistent year to year. They're currently at $27 billion. This is the company's income statement. All their financials are in euros. I converted all the numbers from euro to US dollars onto my Excel spreadsheet since we're looking at the ticker that trades on the New York Stock Exchange. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor. Revenue minus cost of revenue gives you your gross profit, which is pretty consistent year to year, a little over 8 billion euros. Below that is operating expenses. Examples are marketing, depreciation, research and development. Their operating expenses decrease a lot from year to year. So their operating income was much higher in the trailing 12 months when compared to 2018. So it looks like they're becoming more efficient and more profitable. I like to focus on operating income when I look at the income statement. That's a much better indicator of the company's core business than net income. Below that is the interest they pay in their debt, which is around 200 to 300 million euros a year. Below that is other income and expenses. This is a mixture of asset impairments, write-offs, restructurings, and the gain or loss from the sale of a security. And the bottom line of the income statement is their net income, and they have a big negative 2.5 billion euros in 2020. The only reason they have a big negative was this 3.3 billion deferred income taxes. But you'll see on the statement of cash flows that this doesn't affect their cash flows. This is more of an accounting item. Here's a breakdown of their revenue by region. They have their most sales in North America because the United States is their biggest customer. Then Europe is second at 6.6 billion euros. Most of their sales are from cell phones and communication equipment, 18 billion euros. The most sales are in the US by far because the US is such a big country, over 300 million people. In Finland, they only have 5.5 million people, but they still do a lot of sales, 1.5 billion euros. Third is France at 1.4 billion, and a little under 1 billion in India and China. This is the statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So you can see they generated 1.8 billion of cash flow in 2020, even though they had a big negative in net income, because that negative was due to an income tax deferment. When you invest in a company, always follow the cash. That's how you get all your information, where the cash flow goes. That's why operating cash flow is a better indicator of a company's financial health than net income. They generated nearly $3 billion of operating cash flow in a trailing 12 months. Then you have capital expenditures, which are investments in property, plant, and equipment. They spend a good amount of money in CapEx each year. Operating cash flow minus CapEx gives you your free cash flow. This chart is from Yahoo Finance. The free cash flow number does not subtract out the CapEx. It is correct on my Excel spreadsheet. That's why I put a red line here. Their CapEx was higher in 2018 and 19 than their operating cash flow, so they had negative free cash flow those 2 years. They did have positive in 2020 and a trailing 12 months. They do add debt every year. In 2018, they added $139 million of debt, paid down $31 million, so they added about $100 million. They added $50 million in 2019 and $1 billion in 2020. When a company adds a lot of debt and has a lot of free cash flow, it's likely they're using that debt to acquire another company. Let's look at the capital structure. $17 billion of equity, $8 billion of debt. They're 69% equity, 31% debt. Their net debt is negative $3.5 billion, so they could pay off all the debt with the cash on their balance sheet and still have $3.5 billion of cash left over. So they're sitting on a lot of cash. When a company can pay down all the debt with the cash on their balance sheet, it's almost like they have no debt. Because if you owed $100,000 on your home and had $150,000 invested because you feel you could make more money investing your money in stocks than paying down your mortgage, you're in really good shape. It's almost like you have no debt. But if somebody had a $100,000 mortgage and only had $10,000 in the bank, then that person has a lot of debt. Their WACC is 6.7%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $56 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $50 billion. We divide that by 5.6 billion shares. And we get a calculated stock price of $8.80. They're trading at $5.48, so they're trading at a 38% discount. It is a buy according to the model. Simply, Wall Street values the company at $5.55, so they're pretty much saying the stock is trading at intrinsic value. 9 analysts priced this stock, and the average price target was $5.79. The low was $5.17, the high was $6.69. This is the stock price since it started trading. So it looks like it peaked at about $60 in the late 90s. Then it came down and there was a jump up in stock price, but then it kept coming down real low. And it looks like it was fairly flat for a long time. This is the stock price the last 12 months. So this big jump in stock price was during the Reddit short squeeze. But as usual, there was a big sell-off and that brought the stock price crashing down. It has come up a little bit since then, but it looks like it's still trading at a major discount. This company is still involved in the cell phone market. They sold 55 million phones in 2020, which of course is a lot less than Apple, who sold over 200 million phones. It's also a lot less than Nokia sold 10 years ago. The reason the stock price jumped over 100% in January was during the Reddit short squeeze. A lot of investors bought GameStop, AMC, and Nokia, and some other stocks to force short sellers to buy the stock at a higher price. A short seller bets a stock price will go down, and if it goes down, they make money. If it goes up, they lose money. But if the stock price goes up, the short seller has to buy the stock to replace their shares. When there's a lot of short sellers in the market, they all have to buy the stock at the higher price, which pushes the stock price even higher. That's pretty much how the stock market works, supply and demand of the market. The more demand for a stock, the higher it goes. The less demand, the lower it goes, until equilibrium is met. The difference is, Nokia is a good company. GameStop and AMC can be argued that they are struggling and they might not be around in 5 to 10 years. Nokia is a solid company that employs a lot of people, that has good products that are used all around the world. So if you bought Nokia and are losing money because you bought it at $8, $9, $10, you can just hold on, because I think the stock price should go back up. Where if you lost money on AMC and GameStop, you may never make your money back. They have a beta of 0.56, so the stock is less volatile than the market. The stock has gone up 21% in the past 52 weeks, while the S&P 500 went up 31%. So you would have been better off buying the S&P the past 52 weeks than this stock. The 52-week low was $3.21, the high was $10. That's because of the short squeeze. And the stock is trading well above its 50-day and 200-day moving average. This is a really liquid stock. 40 to 70 million shares are traded each day. If I look at a stock and it has 5 million shares traded each day, I think that's pretty liquid, and this is more than 10 times that. Of the 5.6 billion shares outstanding, 4.6 billion are on float. When a share is on float, that means it's available for investors like me and you to purchase. And only 0.5% of the shares are shorted. In the past 52 weeks, their stock went up 23%, which is better than its industry of 20%, but worse than the market of 39%. In the past 3 years, this stock has decreased 5%, while its industry and the market increased. In the past 5 years, this stock has only gone up 9%, its industry almost 100%, and the market well over 100%. Analysts are forecasting their earnings to grow 29%, its industry 12%, and the market 15%. Although analysts are only projecting their revenue to grow 2%, its industry 4%, and the market 9%. In the past 5 years, their annual earnings decreased 5%, its industry decreased 2%, and the market increased 12%. In the past year, their earnings decreased 700%. That's mainly from that income tax deferment, but their cash flows went up a lot, so you should look at cash flows. Their industry went up 89%, and the market went up 21%. If you invested $10,000 into this company 10 years ago, you would have been on a roller coaster ride, up and down and up and down. But if you're still holding, you'd be at $11,300 today, only a 1.25% annual return. The biggest shareholder is BlackRock at 5.5%. They're the world's largest asset manager, with over 9 trillion of assets under management. Next is Solidium, which is a Finnish investment manager, with over 7 billion of assets under management. Next is Vanguard, which is the largest mutual fund with over 6 trillion of assets under management. Next is Norges Bank, which is a central bank of Norway. And last is Ilmarinen, which is a Finnish pension fund. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income due to that income tax deferment, so we can't look at the PE. Price to sales is 1.1. That means investors are paying $1.10 for $1 revenue. That's a really good price to sales ratio. When a company has negative net income, we usually look at the price to sales ratio. The good thing about the price to sales ratio is it can never be negative. Price to book is stock price over book value per share. They're at 1.8, which is also better than the market median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's total assets minus total liabilities. And they have 17 billion of equity, 8 billion of tangible equity, because they have a bunch of intangible assets on their balance sheet. A company gets intangible assets on its balance sheet when they acquire another company for more than its net assets. Their return on invested capital is 11.3%. That's a good sign their ROIC is greater than their WACC by almost 5%. Their interest coverage ratio is 9.7, so they can cover their interest payments almost 10 times. They have negative net income, so they have negative ROE. Their current ratio is 1.6, so they can easily cover their current liabilities with their current assets. And their current assets are 9 billion euros of cash, 6 billion of receivables, and 2 billion of inventory. So the company is more than well capitalized. They had 2.8 billion of free cash flow and over 8 billion of working capital since they have so much cash on their balance sheet. They have over $11 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 10 companies in the same industry as Nokia, and if Nokia has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at their PE. They're doing much better than average in price to sales and price to book. They are lower than average in current ratio. They have a negative ROE, but it is better than average because the average is so bad in this industry. They're lower than average in debt, and they're pretty close to average in market cap. They're a little over $30 billion. And they don't pay a dividend. They stopped paying dividends in 2019. So to summarize, I have them trading at a 38% discount, but this company has been around over 150 years. Finnish people will make sure this company's around because it's such an important part of their economy. They also make good products, they have a good brand name, and their products are purchased all around the world. So I do think it's a good long-term hold. It could take a few years for the stock price to really pop, but when it does, you'll be really happy. I rank their free cash flows 9 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.